Now, there's always this debate that you see on the internet between good debt versus bad debt. Bad debt is your consumer debt, the debt that you use to finance your liabilities, your car payments, your credit card debt. All of these things are bad debt. You buy now, pay later for your TV and your clothes. That's bad debt. And then you have people talk about the good debt, which is the debt that you can use to go out and buy a rental property. Because now, if you can borrow $100,000 and go out and buy a rental property that's going to make you money, this is good debt because now the $100,000 is making you money because now this $100,000 is buying an income producing asset. So that's good debt. $100,000 to finance a car, bad debt because that car is losing value and it's costing you money every single day. Now, the thing that I want to mention about this is there's no such thing as good debt. All debt is bad, but some debt can make you money. So the reason why I say no debt is good debt is because that good debt can turn bad very quickly. And I've seen this happen many times. And this is where if you don't take care of that good debt, it's going to turn around and bite you very fast. And let me explain what I mean by this, because I've been a real estate investor for a long time now. And some of the best deals that I have gotten was when good debt turned bad. Now, it was good for me, bad for the person that used that quote unquote good debt. Because now let's say you buy a property for $1 million. You put in 25% as a down payment. You put down $250,000. You finance the other $750,000. Now, a few things can happen. Number one is the best case where you take care of the property, things go well, the property value goes up and you start making more money and you can pay all the debt payments. That's great. But other things can happen as well. Let me talk about actually the way that the internet makes it seem. Because the internet makes it seem like this, that you go buy the $1 million property with 25% down, you put in $250,000, you finance $750,000, you put in some more work, you raise the rents, and now this property value goes up to $1.5 million because you did everything right. Now what do? You do a cash out refinance. Now you pull out $1.2 million. You have $300,000 worth of equity, you pull out $1.2 million to pay off your previous mortgage, and you put some money in your pocket. Now you have no cash in the deal. You got some free cash in your pocket. Now you can go out and have a nice car. You can go out and go on a nice vacation and have money to spend. And this $1.5 million property is now paying for your debt. But then what can also happen is the economy takes a turn for the worst. And then rents start to fall because, people start losing their jobs, incomes fall, and now you have to cut rents. And now that you cut rents, you have less revenue coming in. And maybe you see a little bit more turnover because what tends to happen from my experience is that when bad things happen in groups. So now you see a couple of tenants leave, you have to lower some of your rents, and now your revenue has fallen. But your expensive has also risen because you have more debt on the property. And now you might be struggling to make some of the payments on the property, and now you try to sell because you're like, I just want to get out of the deal. It's causing me a lot of headaches. You have $1.2 million worth of debt. You can't find a buyer because you're in a recession. And now you're stuck. Maybe you can sell it for $1.2 million and get out easy. Maybe you can't find a buyer for over $1.1 million. And now you have to come up with $100,000 to sell it. Maybe the bank now comes in and takes the property away from you and you foreclose on it. And then they sell it for a discounted price. See, it was good debt. You were living high. It was all great. And then it turns around and bites you. Now, what I'm saying here is not that you shouldn't use debt, but rather understand debt and treat it as it should be. Debt is dangerous, whether it's bad debt or good debt, but that good debt can turn around and become bad very quickly, which is why if you're going to use debt, that's fine. Nothing wrong with it. Use debt if you want to help grow your investments, to grow your businesses, to do whatever it is that you want to do, as long as you understand the risk, but understand that it can be very bad. And you want to be very careful with that debt and treat it as it is, which is it's debt. And it can turn around very quickly because people can get high on this debt. Too much of a good thing can be a bad thing. And you see this especially in real estate. I've seen this many times in real estate, which is why I'm focusing on real estate, because people can get high off of that good debt, especially when the economy is booming, especially when property values are rising. You start to buy properties, refinance out, pull out your cash, pull out more cash, buy another property, do it again and again and again and again. And now you have this large portfolio of properties very over leveraged. Now, this can make people very rich when you do it the right way. But when you get greedy and you start using too much of the good debt And now you start having all the nice things, right? You start having all the toys. You got to have the nice car because you're a great real estate investor. You got to have a big home because you're a big real estate investor. You got to have the nice vacations because, you're a big real estate investor. And you're using all this good debt. Well, when things turn around, because the reality is nothing can go up forever, things will turn around. You have up periods and down periods. The first person to lose their shirt are the people that have way too much good debt. I'm going to jump back into the video in just 1 second, but before we do, if you are an investor and you're looking for an easy and free way to stay up to date on what's happening in the top financial news, from the economy to the housing market to the stock market to the crypto market to the global economy, then you have to check out Market Briefs. Market Briefs is my free financial newsletter that I created that will keep you up to date on what's happening in the financial news. You can read the newsletter in less than 5 minutes every morning. It's a fun and easy to read email, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. So yeah, there is bad debt. Bad debt is when you use it to go out and finance things that don't make you any money. Your credit card debt is bad debt. Your buy now, pay later debt is bad debt. Your car payments are bad debt. That good debt might be making you some money, but that good debt can turn around and be bad just as fast. And this is where now understanding that cautiousness, that some debt can make you money. Some debt can increase your wealth, but that doesn't make it good. You still got to treat it with caution because that good debt can turn around and become bad just as quickly if you do not watch it carefully. And that's where you want to be very careful with the amount of debt that you use and how you're using debt, because obviously no more financing things that don't pay you, that aren't making you any money, that you do not need, period. No more financing the consumer liabilities, no more financing those consumer goods, period. Should you finance some of your investments? Sure. It can make you a lot more money. It can amplify your wealth. It can allow you to grow a lot faster. Nothing wrong with that. Use it. But treat it as it should be. Treat it with caution. Understand that debt is not to be played with. It is fire, and it can burn you just as fast as it grew you if you do not treat it with that caution. If you want to be a successful investor, there are 10 mindset traits that every successful investor has that I'm going to go over in this video. And number one, if you want to be a successful investor, being avoiding the shiny object syndrome. Now, when I say shiny object syndrome, I don't mean now you take your money and you go out and buy fancy cars and nice things, because that's the attractive thing to